start recording. Okay.
Yeah, fine.
Yeah, but we were unable to see Mr. Saurabh Mukherjee. Is there a problem with the video or?
Every time I'm switching the camera on, it auto switches off. So I don't know. I'm turning on the camera, but within 1 second, it's auto switching off. I don't know what to do.
But sir, you have to, but your face should be there. We will be taking a photograph of all. Kindly.
I'm trying my best, sir. I'm just like I've turned it on.
You are on MacBook, huh? You are on Mac, is it?
No, sir. No, ma'am. Normal laptop, normal PC.
Sort of just
every
try.
Time I see it on, it's.
Sort of just check one thing. At the bottom left where it says type here to search, just type camera. And there will be an app of camera. Just see if your camera is getting detected. Otherwise, you might have to restart your laptop.
Bottom left. Bottom left camera. Okay. Can't start your camera.
The camera.
So you're saying I should re-log in? I should log in again?
No, you should restart your laptop. Sorry.
Okay. Okay. So why don't you folks kick off? I'll restart and I'll come back.
Okay.
Thank you.
So Mudhumita madam, you start.
Do we start?
Yeah.
Yes, sir. A very, very good evening, everyone. So we have the WEBINT for today, which is organized by the Banking and Financial Services and Insurance Board of the Institute of Cost Accountants of India in association with the National Institute of Securities Market on how investors can analyze annual reports to detect both wrong companies who steal money and identify great companies who create massive wealth. We have eminent personalities and eminent dignitaries, speakers with us today. And just in short, we have been observing August 2021 as the Investor Month. And there has been a list of seminars and webinars which have been organized by BFSIB in association with the Institute of Cost Accountants of India, as well as in association with the National Institute of Securities Markets, that's NISM. So we have the WEBINT for today, and just in short, the program overview. Technology is sweeping the world and is doing it at faster than all of us can anticipate or predict. Every single aspect of human behavior is getting disrupted. Investing, long considered an art confined to by smart bankers and advisors, is the new bastion being eyed by technology. Even as many of the older investors struggle to complete their targeted investments, tech-savvy millennials continue their investment journey uninterrupted through digital modes to grow financially. Apropos to this, ICAI and NISM have launched a successful series of online investment management programs that leverages on the strength of both institutions' partnerships. Both institutions have planned to observe the month August 2021 as the Investor Month to spread the investment awareness among the professionals. The Investor Month observance is an initiative of the Banking and Financial Services and Insurance Board, that's BFSIB, which is called in its short name of the Institute in association with National Institute of Securities Market, that's NISM. Distinguished speakers from the securities market are invited to share their thoughts and experiences on the relevant topics, and with their gracious presence, these events are a source of inspiration to all the participants who have been watching us worldwide and will serve as a guidance in carrying out future endeavors in a much, much better manner. All the events have been streamed live through the official YouTube channel of the Institute and have reached the stakeholders, members, students, investors, all professionals of both the institutions across the country. Just to mention, eminent personalities were a part of all these webinars and webinars from the industry, from reputed industries, and we have been conducting webinars in the previous days. Like, we started off with the new age investment in an era of low interest Great. We had the webinar Demystifying Mutual Fund Schemes. We also had the webinar on IPO investments, global investments through Indian mutual funds, and very recently on 31st of August, we had the webinar with the Durgapur chapter, investments in capital markets post-COVID. So without wasting much of time, we start the webinar for today, and we are really waiting hard to hear from all the eminent speakers on today's topic, how investors can analyze annual reports to detect both rock companies who steal money and identify great companies who create massive wealth. We have with us the guest of honor and speaker for today, Sri Saurav Mukherjee, founder and chief investment officer of Marcellus Investment Managers. We have with us Dr. V.R. Narasimhan, Dean, School of Corporate Governance and School of Regulatory Studies, NISM, and CMA Dr. Lata S. Chari, Associate Professor, NISM. So we start the webinar of today without wasting much of time with our institute anthem.
असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय ॐ शान्ति शान्ति शान्ति.
So we are all set for starting the webinar of today, and we started with the welcome address by CMA Chittaranjan Chattopadhyay sir, our chairman JFSIB.
Thank you, Dr.
Over
Sengupta.
to you, sir. Yeah.
Thank you, Dr. Sengupta. Very respected guest of honor today, the main attractions of today's program, Saurav Mukherjee, a speaker, an author, a doyen of this investment world. We welcome you, sir, in this particular program in association with NISM, and the very respected Dr. V.R. Narasimhan, who has always become a source of inspiration for this venture of Institute of Cost Accountants of India, NISM, Sri Sunil Kadam, Registrar of NISM, who is also one of the prime mover, and our Dr. CMA is Lata Chari, Madam, who is always guiding us. And I am today we are related to have the presence of Mr. Rakshit Ranjan, Mr. Sholil Desai, all our students, all our dignitaries who are watching this program, and our Vice President, CMA P. Raju Iyer, who has always been with us for this sort of programs. Ladies and gentlemen, this program today we are organizing, and today's WEBINT in association with NISM and the founder and chief investment officer, Marcellus Investment Managers, Sri Saurav Mukherjee, who is the guest of honor and the key speaker on the topic of how investors can analyze annual reports to detect both the rogue companies who steal money and identify great companies who create massive wealth. We hope for huge participations from member students and both the institutions and others. We are thankful to NISM, namely Sri Sunil Kadam, Registrar of NISM, Sri V.R. Narasimhan, Dean, School of Corporate Governance and School of Regulatory Studies, NISM, CMA Dr. Lata S. Chari, Associate Professor, NISM. Today's topic, how investors can analyze annual reports to detect both rogue companies who steal money and identify great companies who create massive wealth, is a burning topic in which we are exposed to an information overload, but how to make proper decision making through proper analysis is never stated in any report. We know that statistics is a big lie. It reveals lies and covers more, and so the art of comprehending figures and correlating them with various events and activities is the task of an expert. It is being actually thought by the many people what I'm quoting today, that statistics is a big lie. It has been quoted by many people. But we also know that is the key indicator for safeguarding the financial investments of common investors. We should only rely on ratio analysis or management reports, which are billion-dollar questions, which would help the common investor track the financial reporting of the companies and comprehend the various figures and infer a right decision making. We have already read the book of Coffee Can Investing, where Sri Saurabh Mukherjee elaborately explained the sound investing concept for a common investor. His recent book of Diamonds in the Dust, Consistent Compounding for Extraordinary Wealth Creation, is a must read for every investor, which is an eye-opener, where an investor can correct their mistakes and invest in proper companies, which will help them to achieve the financial goals. With these above submissions, I thank NISM and CEO Saurabh Mukherjee for his gracious presence. We request all the participants to please raise your queries of your personal finance to be addressed in this forum. I welcome you all, sir, for your august presence during your busy schedule. It has been possible for you to come to our institute's forum, and we welcome you for the future program also. We welcome you to be with us. Thank you.
Thank you. Thank you very much.
Over to Madhumita.
Yeah, thank you, sir. Thank you very much. And we now have the special address by Dr. V.R. Narasimhan, Dean, School of Corporate Governance and School of Regulatory Studies, NISM. Over to you, sir.
Thank you, Ms. Madhumita. Mr. Raju Iyer, Ms. Chitra Bandyopadhyay, the guest of honor and speaker of the evening, Mrs. Saurabh Mukherjee, my colleagues, and office bearers of Institute of Cost and Roads Accountants of India. Welcome to this special session on investments, understanding investments through annual reports. I think this is a very important and very timely topic because the annual report season is getting ended now. General body meetings will get over by September 30th, and all disclosures, annual disclosures, come to a closure. And we'll wait for another 1 year before next set of disclosures will come. Students who have been following Companies Act closely and SEBI regulations, listing regulations closely, will appreciate that regulator has been taking extra care to see that more and more disclosures will come forth so that investors will be able to understand what to do. I mean, with any investment that you make, direct investment you make in an equity, you have 3 types of questions before you every day, every time. Should I hold this? Should I sell this? Should I acquire more of this? This is a question that everybody faces, and it's a very natural question. Say, I already have 100 shares in this company. Should I be buying more? I have 100 shares. Did I commit a mistake in investing it? Or it's okay that I just keep this 100 and go for something else to be bought? How do you understand this? To understand this, the only window is the disclosures that the company will make. And disclosures come in different forms and different methods. And annual report is one of the most important ways in which most comprehensive and most reliable, most authenticated disclosures will come. And we have seen that annual reports size has been increasing in bulk because regulators and legislature has been mandating that so much of information has to be definitely given in annual report. What do we do with this information? The information has to be understood to understand what's happening with the investments. In fact, there's a beautiful statement saying that it's a mandatory for every company to disclose how did they use the money that they have raised through, whether it's a public issue, through debt, or any other means. That is, you raise money from the market in different forms, in any way, how did you use it? And the way in which the money has been used, and if the deviation has been specifically disclosed, and sometimes even it requires a kind of an approval from the general body, etc. So the immediate information is that what has happened with money already given to the company, is it going the right way? All of understand that once you invest in equity, the only way in which you can get back your money is not from the company, but from the market. And how will the market give you back? Market will give you back with an increased value, reduced value, or sometimes it may go illiquid and you may not be able to even sell what you have invested. I think the topic given to Mrs. Saurabh Mukherjee, and actually so, the person who understands this investment very thoroughly, I think he will explain us as to in terms of how will you actually take a decision whether to hold, sell, or buy some more. It's a very interesting topic. very important topic for all of us to manage our investments. I think it's an important mantra as far as this particular investment is concerned. I'm very happy that this topic is being spoken by none other than Saurabh Mukherjee, who himself is an author of books and who's managing an investment company himself. And we all await his talk. Thanks for the opportunity to say a few words. Thank you.
Thank you, sir. Thank you very much. And we just hand it over now for address by CMA P. Raju IS, sir, Vice President of our institute. Over to you, sir.
Thank you, CMA Madhumita Sengupta, our respected Chairman, CMA Chitran Chattopadhyaya, Chairman for BFSI and Indirect Taxes, who is meticulously organizing the programs and every month as a particular month for agriculture, for MSME, and this month for investor. And respected our Chief Guest, Sri Saurabh Mukherjee, and the eminent speaker, V.R. Narasimhan, who has just now addressed, and CMA Lada S. Chari, and Salil Desai, and Ranjan, and Sunil Gadam. We are having very eminent speakers and resource persons. As I pointed by CMA V.R. Narasimhan, a lot of things has to be get interpreted from the annual report. The listed companies come out with their annual report highlighting their performance to its shareholders. These reports are always available to the company, primary source of information to the shareholders and the public. So normally it is available, sent by the company's website or in BSE, NSE websites and all other details. And in fact, a lot of things have been highlighted in the annual report, especially vision and the mission statement of the company, the corporate information and the product details and their financial highlights in the last 5 to 10 years, director's report, management discussion and analysis report, report on corporate governance, information about the shares held by the shareholders of the company, and auditor's report, financial information, and note to the accounts. All these information are very important, especially vision statements and all. We all know that's all it has been done. And again, how the company is having corporate information regarding the auditor, directors with whom they are banking, those information are given in the corporate information. And product and financial highlights the last 5 years are given in normally by most of the companies. The director's report highlights what are its policies, how it has performed the last year, and who are all the auditors, who are all the directors, what are all the changes. Those things are highlighted in the director's statement. Some companies are, most of the big companies are giving chairman statement also. The difference between chairman statement and the director's report is that director's report is as per the Companies Act and it's a must in annual report. As well as chairman statement is concerned, they can give any report, their vision and what they are planning, and all those aspects can be given in the chairman statement, which cannot be taken as a for legally held responsible. But whatever stated in the director's report, it can be held as a legally responsible. And other management, MDA, management discussion analysis report, which is called MDA report, which is very, very important. Because in that they have done the SWOT analysis and how the company has performed, what plans they are having, what is their strength, what is their weakness, what is their opportunity, all those things. And again, director's report, as I said, it will be highlighting all detailed information regarding this, and any discrepancies and all those things are highlighted in the director's report. And the report on corporate governance, how the corporate governance, who are all the independent directors, and those details has been given in the corporate governance statement. And information of shares holding of the company, any changes in the shareholding of the company, who are all the major shareholders, what percentage they are holding, how much is the public shareholding, those things are given in the shareholders report. And the auditor's report, which is very, very important. If the company, whether auditors are find out any deficiencies, whether internal audit is adequate with the systems and the procedures of the company, whether they are able to, management is able to, they are able to get all the information and what are the highlights, those things have been given in the auditor's report. If the auditor's report have any negative, that will have a major impact and it has to be investigated. Of course, financial statements are excellent things, the income statement, balance sheet, cash flow, and all those information are very general, which will be highlighting the company's performance in the last years and all the things. And notes to accounts, which will be giving how the accounting policy, what are the accounting policy, how the numbers have been moving, and all the what is the depreciation policy, if there are any impairment of assets are taking place, and practically now they have to inform about what is the impact of COVID-19 also, whether it has affected their cash flow, whether it has affected this, and what is the impact of COVID pandemic effective also. But all these things will be giving the information if the annual reports are genuine and if it is giving the real information. But actually the problem is that the question is how can the creativity in the accounting is detected through the results they analyze, and the quarterly and annually. If the number of numbers, if we compare between one quarter to other quarter and annual, if the numbers are varying, now we can say that there is a creative accounting has taken place, and which has been presented in whether oversetting income or undersetting expenses or profit or loss, whatever things. And the examples are Satyam, what has happened, and all those type of things. In some of the companies, if you take practically, the auditors will be resigning and changing. You can analyze from the various things that is happening. Some companies, within 3-4 years, there will be 4-5 auditors changing also. Same way, the independent directors, how independent directors are moving, whether independent directors are resigning and what reason they are giving for their resigning, those things also very, very important. So more than the financial information, the other information are very, very important. The auditors statement and how the auditors are moving, who are all the auditors, whether auditors having any remark, and whether audit partners are highly qualified and having reported. And same way, independent directors, who are all the independent directors, whether independent directors are really working on whether they are following rules and regulations. That is also very, very important. And we are having a very eminent speaker, as pointed out, our chief guest, Saurabh Mukherjee, who will be highlighting all these issues, who is having very well experienced person, and a very eminent speaker, our registrar also, and we will be having a very value addition session, which will be highlighting all the issues. Thank you for the opportunity. Wishing everyone a happy, healthy, and prosperous and peaceful days. Thank you, thank you, thank you. Good day.
Thank you, sir. Thank you very much. And we are just going to start with the address and presentation by Sri Saurabh Mukherjee, Founder and Chief Investment Officer, Marcellus Investment Managers. So just a few lines about him before he starts off. Saurabh Mukherjee is the founder and chief investment officer of Marcellus Investment Managers. He was educated at the London School of Economics, where he earned a BSc in Economics with first-class honors and a MSc in Economics with distinction in macro and microeconomics. In London, he was the co-founder of Clear Capital, and in 2007, he was rated by the Excel survey as one of the top small cap analysts in UK. In India, he was rated as the leading equity strategist in 2015, 2016 and 2017 by the Asia Money polls. Prior to setting by Marcellus, Saurabh sir was the CEO of Ambit Capital. So, over to you, sir. And like sir has already said, the person who understands only investment and no one understands investment better than him, we all are eagerly waiting to hear from you, sir. So it's all over to you now.
Thank you very much. Thank you very much, Madhumita. Thank you to NISM, to the Institute of Cost Accountants for inviting myself and my colleagues to talk about our new book, Diamonds in the Dust. All of you have mentioned how vast this subject is. Corporate governance, annual report analysis, investing, these are vast subjects. We could spend, I think, an entire year discussing the amount of depth, discussing these subjects in depth. So what we will do is, rather than take an entire year, we'll spend around 20 minutes. My colleagues and I will spend around 20 minutes sharing with you how we understand the subject, how we have presented the subject in our new book. We've deliberately kept these explanations at a level where everybody can understand. And if there is time after that, happy to take questions and then go get into these vast subjects around accounting, around forensic accounting, corporate governance, and investing. We're happy to get into it in greater depth in a Q&A session once we have given you the sort of basic crux of what we have said in Diamonds in the Dust. Right. So a little bit of background on my colleagues first. So my colleague Rakshit Ranjan, he and I have worked together for 17 years, pretty much from the time Rakshit graduated from IIT Delhi as a young engineer. He's also a CFA charter holder. He actually, very early in his career, he became one of the top insurance analysts in the UK. He manages our flagship portfolio, Consistent Compounders. And Chairman Sir very kindly mentioned Coffee Can Investing. Rakshit is the co-author of Coffee Can Investing as well, other than being an author of Diamonds in the Dust. Salil is a chartered accountant. He's got 16 years of experience in the equity market, of which 10 years was spent in India's largest family office. In fact, Salil spent 10 years managing wealth for one of India's richest promoters. He manages Marcellus's largest advisory portfolio. So there's three of us. We will take you through our view on how to invest. What we do in Marcellus is actually very simple. We look after the wealth of more than 7,000 families now, and we invest their life savings using three very simple principles. Firstly, we're looking for clean companies, promoters who are not cooking the books. Unfortunately, such promoters are hard to find in India, but that's the first priority for us. Secondly, we're looking for rational management teams, rational promoters, companies who know how to allocate capital. And thirdly, beyond cleanliness and rationality, we're also looking for dominant companies, dominant franchises, right? Companies who dominate their industries. These are the three principles. And the book Diamonds in the Dust is an elaboration of how these principles are implemented by the team at Marcellus on a day-to-day basis. Now, question is, it's actually a lot of hard work to write these books. It takes us the best part of 2 years to pull together a book which is useful for you. Why do we bother? Why do we bother writing these books? We write these books because we know that 99% of Indian investors will never be able to become Marcellus clients. They unfortunately won't have the wealth which is required to become a client of ours. And yet they need our help, your help. And why do they need our help? Why is it so difficult to make money in the Indian stock market? There's a lot of new people, and there's a lot of excitement around the stock market. A lot of newcomers are entering the market. But what they don't realize is India is one of the hardest stock markets in the world to create money. What they see is that over the last 10 years, the stock market in India has created a great deal of wealth. It has created roughly $1 trillion of wealth, right? But if you look deeper, what you'll see is that barely 16 companies, 16, have accounted for 80% of the wealth created by the stock market in the last decade. And the reason for that, if you go one level deeper, is India's profits are now in the hands of basically 10 companies. 10 companies now account for 90% of the country's profits, right? This is the happy side of the Indian stock market story, right? Vast wealth creation by a dozen and a half companies, right? The majority of Indians, however, don't see this positive side of the stock market. They unfortunately invest in stocks which don't compound. So if you look at the BSE 500, the stocks that were listed in the BSE 500 a decade ago, half of them are out of the index. Many of them have faded into obscurity. The BSE 500, as it was a decade ago, 85% of that index has failed to generate even a return commensurate to the cost of capital, which is 15%. And again, the reason for this is not hard to see. 70% of listed companies in India can't generate a return on capital above their cost of capital. Basically, that means these companies don't generate any free cash flow. These are dud companies, but unfortunately, millions of Indians put their life savings in these companies, right? So this story of opportunity and risk, wealth and disappointment coexists side by side. Our goal in Diamonds in the Dust is to give you a method for investing which swings the odds in your favor so that you too, like us, end up investing in these dozen and a half companies which actually compound wealth rather than in the many hundreds of companies which can't compound wealth. So how do we do that? How do we do it? I'll request my colleague Salil to give you a sense of how we go about investing monies for our 7,000 odd clients. Salil, over to you.
Thank you, Saurabh. And good evening, everyone. So like Saurabh mentioned earlier, right, the first step in our investment process is to find companies with clean accounting. And this should really be the first step in anybody's investment process, right? The first rule is you don't want to lose money. Now, why is that important is because we rely on the financial statements to analyze the business, to assess its value. And if these financial statements are we can't trust them, then really there's no point in the whole exercise. Now, what typically happens is, when we think of accounting irregularities or frauds, only large or big ticket names come to mind, right? Satyam Computers, for example, it happened 12 years ago, but still that is something fresh in our memory. But what really happens is that accounting deception is far more widespread and happens more frequently and more commonly than we think. We'll give you 2-3 examples of some recent cases. Divan Housing Finance, housing finance company. The company had reached a peak market capitalization of about 20,000 odd crores. When a forensic audit was commissioned, they found that 17,000 crores were siphoned off from this company, right? So an amount equivalent to 85% of market capitalization was siphoned off. Another company, Deccan Chronicle, at one time they were one of the largest selling English newspapers in India. From one financial year into the other, they had to restate their debt up by 5x, which means that they were under-reporting of debt by almost about 81%. And then there was Cox and Kings, a leading travel services company. This company, at the end of one financial year, they had a positive net worth of 4,700 odd crores. And by the end of the next financial year, that had become a negative net worth of 7,300 crores. Yeah, this is a 12,000 crore swing in just a period of 12 months. So every month, 1,000 crore knocked off from net worth. Now, the biggest problem or the most worrisome aspect of these facts is that the retail investor or the individual investors like you and me, they bear the biggest brunt of these accounting irregularities. But, again, we'll go back to the Divan Housing Finance example. When asset quality concerns started emerging on the company, the stock in a short span of time declined by about 68%. Right? This included a 40% fall in a single day. In one day, the stock fell 40%. Now, what happened after this decline? Retail shareholding in the company increased from 17% of total to 48%. So basically, retail shareholders ended up owning 50% of a company when a fraud was already out in the open. Today, DHFL is most likely to get delisted because of the results of its insolvency proceedings, and the value of equity is zero. So the 50% owners of the company who are retail shareholders are not going to get anything for their investment. Now, generally, why this happens is there are three typical ways in which investors get trapped. The first is they don't have the tools or the resources to detect any accounting irregularity in advance. Right? You want to know before you invest if there is something wrong or not, which most of them don't have the access to. The second is that many are aware of something going wrong, but they think that they can get out before it is too late. And third, and the most common ways in which investors get trapped, and this is what happened in the chart that you see on the left in DHFL, is that after the stock has declined on results of a fraud or on news of a fraud, investors think that now this stock is cheap. The risk is priced in, and if there is a turnaround, we'll make lots of money. But that hardly ever happens. So what you really need is checklist of accounting quality and governance standards that can help you detect these in advance. And in the book, we have dedicated 2 whole chapters to this. So we have given a set of forensic accounting ratios as well as governance checks, which Mr. Iyer elaborated on earlier on independent directors and related party transactions and so on. And this is what you really need to make sure that you don't lose money. Now, this part is all about which companies you should not be investing in. Then the question comes up what companies you should invest in. So I'll request my colleague Rakshit to take you through that part.
Sure, thanks, Salil, and good afternoon, everybody. I think to begin with, just linking in with the slides that Salil presented on, there's an interesting data point about India's stock market, which is that indices like, say, Sensex and Nifty 50 do not outperform India's nominal GDP growth rate over any long time period of, say, 8 or 10 years or longer, despite the fact that these indices should be benefiting from survivorship bias and selection bias of companies that make into these indices. Right now, this lack of outperformance, we believe, is largely due to the dodgy accounting practices followed by many large and dominant businesses which are part of these indices in India. And hence, there's a massive outperformance of a stock or a portfolio to be had only by focusing on clean accounting practices itself. So that's the first layer of alpha. In addition to clean accounting related alpha, an investor also needs to come at stock picking to do stock picking around companies with high quality fundamentals. And there are 3 broad characteristics of a high quality company which an investor needs to target, which are laid out on the slide in front of you. The first one is that the firm needs to have the business needs to have a high pricing power. Now, to begin with, what does pricing power really mean? Pricing power doesn't just mean the ability to hike product prices in order to protect margins when the business is faced with rising raw material costs, right? It also means that even if a competitor starts a price war by offering competing products at 30, 40, 50% discounted prices, then that should also not lead to any adverse impact on either the market share or the profitability of a great franchise. Which in a way means that the business should not be resorting to price cuts in order to protect against market share in the face of intense competition. And in the book we've given in chapter 4 of Diamonds in the Dust, we've provided a total of about 10 such case studies on companies with high pricing power, such as, say, Abbott India, Pidilite, Divi's Laboratories, Garware Technical Fibers, etc. So that's the first bit of identifying high quality companies around pricing power. The second characteristic of a high quality company is that the outcome of high pricing power, which is high return on capital employed and hence strong cash generation, these cash flows should get reinvested in businesses which also deliver high pricing power on incremental investments for the same company, right? Now, this is harder than it sounds in terms of incremental investments returns on capital employed being high. It's harder than it sounds because most successful businesses, they fail to maintain prudence while allocating capital to grow their business beyond the core products and core markets. And in one of the chapters, chapter number 5 of this book, we've given a framework to assess capital allocation decisions with more than 20 examples of prominent and successful Indian companies, unfortunately majority of which had an adverse impact on shareholder returns due to capital misallocation. And then there are also 3 detailed case studies in the book on Tata Steel, Pidilite and Kotak around their capital allocation decisions and the impact it had on their business evolution in the long run. The third characteristic, which the diagram on the top right shows you in this slide, of a high quality company, is that these are institutions rather than one-man shows. Now, institution building at such companies, it actually needs to happen at 3 distinct layers. First of all, at the top, board of directors should be high quality and independent. Secondly, the CXO layer, the senior management layer, should have a very disciplined process of appointing these CXOs, training them far ahead of the sort of time when it comes for the people to become CXOs in these organizations. And thirdly, there should be decentralized execution of business at a ground level through systems and processes. Right now, again, in the book we've given comparisons, some of which are actually not so obvious. For instance, when you compare an Asian Paints and an HDFC Bank on this characteristic of institution building, to most investors, these 2 companies are equally institutionalized businesses. But there are quite a few differences. And if an investor can appreciate those differences, even between an Asian Paints and an HDFC bank type of established businesses, then it becomes easier to sort of identify and allocate your capital in your portfolio only to certain high quality companies in a proportionate manner. So that's about selecting high quality companies. What's the outcome of this? So the outcome of this, broadly speaking, can be broken down into 3 layers. The first layer is summarized in this slide, where these 3 charts, although they pertain to Asian Paints, in the book we've shown that any other such high quality consistent compounder, if you pick up, will have very similar charts around, say, rate of compounding, which is on the left highlighted, is very exponential for such companies, because in the long run, these companies, they compound typically at, say, let's say if they compound at 25-26% annualized rate, then that can lead to their share prices becoming 10 times in 10 years and 100 times in 20 years, right? So that's the exponential piece of compounding. And then the histograms on the right hand side show you that when these 20 years of exponential compounding are broken down into subsets of 12-month periods. For instance, if you pick up 1st April to 31st March financial years, then these companies, to begin with, the histogram on the top shows you, they have very few instances of negative returns, right? Which means that the left half of the histogram is practically blank compared to say Sensex or Nifty, which is at the bottom left, bottom right. You can see the left half of the histogram is not so blank, right? Secondly, even on the right hand half of these histograms, for a consistent compounder, the most frequently visited column of 12-month returns is the more than 30% return column, compared to say Nifty 50, where the most frequently visited column of 12-month returns is the 10 to 20% column. What that then means is when it comes to consistent compounders, just because they've delivered healthy returns in the last 1 year or 2 year or 3 year time period doesn't mean you should book profits. It doesn't mean you should time entry again at a lower point because you've already got a higher point of the share price today. And staying invested becomes far more rewarding than trying to time entry exits or timing the market. More on this timing aspect from Salil in the next couple of slides.
Thanks, Rakshit. So in this slide, we'll try and answer the three questions that Dr. Narasimhan raised, right? If you own a stock, whether you should hold, you should sell, or you should buy more of it. Now, in the previous slide, you saw this chart where a stock had become 155 times over a period of 20 years. But in that chart, there are many ups and downs. It's not a linear chart, straight line. There are many ups and downs. The question is, if you could have timed those ups and downs, buy at the bottom, sell at the top, would you have done better than even 155x, which in itself is a stellar return? The answer really is no. Now, to understand why it is not possible and why it is futile to time the market, let us take a more recent example that will be fresh in all of our minds. Now, last year in January, in 14th of Jan 2020, the BSE Sensex had recorded what was its all-time high at that point. Then as COVID started spreading, over the next 2 months, the Sensex fell or declined by 38%. This was by 23rd of March. Then on 24th of March came the announcement of the nationwide lockdown, which brought the economy to a standstill. Now, everybody at that time thought that things will only get worse from here. Right? All market experts, economists, all commentators were saying that there's going to be a long bear phase in the market. But what really happened? The market actually bottomed the day the economy shut, which means that what you thought is going to happen did not really happen, and that is real. The most likely event that plays out. Right? You never know what's going to happen. So the point that we're trying to make is that timing the market is really futile. So what you should instead focus on is to find good quality companies, because that takes the timing out of the equation. Now let us take an example. If you look at the table on your right, there are two stocks, say an HDFC Bank and Asian Paints, what we call, like Rakshit was saying, as consistent compounders. If you had bought these stocks regularly every year for the last 10 years, okay? And let us take two scenarios. In the first scenario, you buy this on a random date. We have taken 1st of Jan each year. So 1st of Jan each year, somebody buys Asian Paints and HDFC Bank for 10 years in a row. Their compounded return at the end of 10 years would be about 21% and 27.5% in these two stocks. Now, if there is some person, who has some magical formula and says that for each of these 10 years, I can know or I can find out what was the exact yearly low of the stock. So in a year, what was the lowest point of the stock? And he buys the stock at that price. Again, he does the same thing for 10 years. What happens at the end of 10 years? His compounded returns are about 1.5 to 1.8% higher than the person who was buying it at a random date. So what this tells you is that the difference between timing the market and not timing the market is not substantial at all. In fact, you want to test your luck by trying to get 10 52-week lows, it's not going to pay off a lot. So again, the point we're trying to make is that once you buy a good quality company, then when you buy it, at what price you buy it is immaterial. You just have to buy it regularly and you have to hold it patiently over the long term. Now, what does all of this eventually translate into as a end result for an investor. So Saurabh, if you can just conclude this part.
Sure. Thank you, Salil. Thank you, Rakshit. So folks, just to sort of clarify your thinking, right? As we began by saying, the Indian stock market is extremely polarized. The Indian economy is extremely polarized. Today, barely a dozen and a half companies account for 90-95% of the nation's profits. They drive the 90-95% of the wealth creation in our nation. And your and my journey in the stock market will depend on whether you, I, Rakshit, Salil, all of the learned folks on this call, whether we have the wisdom to identify those dozen and a half companies, or whether, like many millions of Indians, we spray our wealth across useless stocks, right? Depending on how you go about it, if you're able to identify diamonds in the dust, you'll be like the happy gentleman on the left-hand side. And if you're not able to identify the sorts of companies we've discussed, you'll be like the disappointed gentleman on the right-hand side. What do you have to do to identify diamonds in the dust? To summarize what we have said, first step, learn how to read annual reports. We've given in the book a whole range of forensic ratios which will help you simplify your annual report reading so that you're able to weed out those Indian companies whose books are fabricated, whose accounts are made up. Secondly, ours is a large free market economy. Learn how to identify companies who actually have pricing power so that they're not ground into dust by the competitive free market forces of Indian capitalism. Again, in the book, we've given you techniques that you can use to identify great franchises with superior pricing power. Right? Rakshit mentioned there's a whole host of case studies of such franchises. And thirdly, the whole point of having pricing power is so that the company generates superior free cash flow, surplus capital, and you therefore need to look for companies who wisely, prudently reinvest the surplus capital. You look for promoters who know how to allocate capital wisely. Once again, we've given you in the book 3 vivid case studies of large companies and their capital allocation. Right? So clean accounting, superior franchises, superior pricing power, good capital allocation, central to consistent compounding, which is the theme of the book. Now, all of that being said, right, you are busy people, you are hardworking students, hardworking cost accountants, some of you are in senior academic roles, and therefore it is entirely possible that you will say, I understand all this and I don't disagree with too much of it, but hey, I don't have the time. I don't have the time to read the book, right? Ours is a society where people are very busy. So that you get the motivation, the necessary motivation to read the book, we requested our guru, Sir John Kay, a man who's taught us immense amounts over the last 20 years. We requested Sir John Kay to write the foreword of the book so that you basically act as a Chavanprash, a tonic to encourage you to read the book. So Sir John says, I quote now from the foreword of Diamonds in the Dust. Sir John says, no one said successful investment was easy, but this book will lead you carefully through the underlying principles. You'll learn to see through deceptive accounting. You'll not learn how to time the market, but you will learn that if you were able to do it by some prescience that no one else has achieved, even if you learn to time the market, you'll learn that the returns from market timing are far less than the returns from effective stock picking. You will learn the nature of competitive advantage and how to identify sources of competitive advantage that are appropriable and sustainable. To invest well, you must understand these things. I hope this book will encourage many people to take control of their wealth management. And if for you, that is a leap too far, as it is for many people, the book will certainly enable you to ask the right questions for your financial advisor. So we'll bring the presentation to an end at this juncture. We're happy to take questions, or if our distinguished hosts so decide, we can give you a flavor for the forensic accounting chapter and the sorts of ratios we've given in the forensic accounting chapter. We've given 4 vivid case studies of large-scale fraud in our country, companies that stole billions of dollars of hardworking people's money and ran away, basically. those monies are no longer in the country, unfortunately, right? We can discuss some of those forensic ratios, which allow us many years in advance before the rest of the market figures out, allow my colleagues, Salil, Rakshit, we've got 13 chartered accountants in the team. We've got 7 chartered financial analysts. We can give you some flavor for those ratios. So I'll hand the mic, metaphorically speaking, back to our hosts.
Thank you, sir. Thank you very much for enlightening us. I mean, it was really a great session to hear from you. I mean, it's long that, every time we hear that, we are we're just waiting to hear from Saurav, sir. So it's really great. Thank you, sir. Thank you very much. And over to Lata S. Chari, ma'am, for the question answer session and summing up of this session.
Madam, please unmute.
Yeah. Good evening, everyone. At the outset, I would like to thank Mr. Saurabh Mukherjee and his team for agreeing to be present here with all of us today. I think every NISM student will be aspiring to become one Saurabh Mukherjee or one Rakshit Ranjan in the years to come, right? And seeing and hearing you actually will fill their minds with a lot of imagination and, of course, a lot of basic facts which can keep them thinking and working in identifying the right kind of companies for investment. So I think I will walk into the Q&A and maybe parallelly do the summarization. So let me, but I think the first question was, you said clean, rational, and dominant. Right. So when you said clean, rational, and dominant, I propose to go with my questions and then I look into the YouTube. You've been kind enough to give us a lot of time, right? So I'll definitely take my questions and I will also take the YouTube. I have my question ready with me. So I'm going with the first question, which is my question, and then I'll look into the different channels and maybe pick out other questions. You said clean, rational, and dominant. What is my question is basically clean. How much time do you really spend on identifying clean companies and filtering them? And you offered that you have a set of forensic factors, that ratios and others that you look at. So if you can just give us some of them, yeah. And also tell us how long does it take to identify a clean company and filter it out from this universe of so many listed companies here. Yeah.
Sure. So Chari madam, thank you for the question. Thank you for inviting us. So we are very fortunate in India, and specifically we are fortunate in Marcellus to have some of India's smartest accountants work for Marcellus. We are huge fans of the Indian accounting community. We believe the process of examination and training that Indian accountants go through is of the highest order. Salil himself is a chartered accountant, and we are proud that there's 12, 13 chartered accountants of Salil's seniority and caliber who work for Marcellus. So what they have done is they have created, first off, around a dozen forensic ratios. The book gives you these ratios.
Sorry, can you just do a plus there and increase the font of that? Yeah.
Sure. So this is page 47 of the book. So I'm just projecting page 47 of the book. So for example, a simple forensic ratio, but extremely powerful one, is what we call the cash conversion ratio, which is the ratio between operating cash flow and operating profit. So if you give someone like Salil the working capital cycle of the industry, he can figure out at what rate should operating profits translate into operating cash flow. So for example, in the pharma industry, for every 100 rupees of operating profit, you should be getting around 85 rupees of operating cash flow. So 85 is the rate at which profits translates to cash flow in the pharma industry. But if you look at the Indian stock market, off the top of my head, there are two prominent pharma companies where you don't see that. You'll see that their cash conversion is 60-65, not 80-85. So what then happens is, so this ratio analysis, and there's 12 such ratios. If you read the book, you'll see there are these ratios. We have elaborated on several of them, right? And we've also given an entire forensic checklist in the book that people can use. But let me just sort of elaborate further using this one ratio, right? So level 1 analysis is using these ratios, right? In level 1 analysis, we will figure out that there's a prominent pharma company whose cash conversion is weak, right? In level 2 analysis, one of our senior analysts, one of our fund managers, will then sit down with the annual report and try to figure out why is this prominent pharma company converting operating profit to operating cash at a subpar rate, right? Why is cash conversion weak? Now, in the case of one of the prominent pharma companies from South India, the cash conversion is weak because the receivable days are elongated. So said pharma companies' receivable days are 130, 140, when typically in the pharma industry, receivable days should be 70, 80. So the South Indian pharma company in this case is taking 50, 60 days extra to figure out, to convert revenues to cash flow, right? So the second level is getting to the bottom of why the ratio is misfiring. Why is the ratio subpar? And level 3 analysis is, if need be, right? By this time, if typically by level 2, you figure out this is a fraud company and you just abandon it. You don't really care whether it's in Nifty 50 or BSE 100 or BSE 500. Typically, it's a fraud company in India. It's not worth our while to then delve deeper. But suppose we were curious. What we would then do is send one of our senior people, say one of our colleagues who's been an auditor, who's worked in a firm like Marcellus for half a dozen years, to this relevant city. So in this case, the city is Hyderabad, and that person will spend 2, 3, 4 days in Hyderabad getting to the bottom of the fraud. Now, as I said, it's not really worth our while, because if you figured out it's a corrupt company, why waste, someone like Rakshit and Salil? Their time is extremely valuable. Why should we waste their time? But if we were the Enforcement Directorate or SEBI, that would be the last step. You'd send a forensic analyst of the caliber of my colleagues to go to the relevant city, to the hometown of the said company, and make detailed inquiries. And typically, if you do typically a week of inquiries, you're able to get to the bottom of it. So level 1, using a dozen such ratios, right? CFO to EBITDA, yield on cash and cash equivalents, change in reserve and surplus, whether it's explained by the P&L or not, right? Going on to say capital work in progress to gross block. You're using a dozen such ratios. You're using 6-7 years of annual reports, and you're comparing a company with its peer group to see whether, say, the growth in auditors' compensation in the company compared to its revenues is unusual or not. So level 1 is a purely quantitative analysis based on a dozen forensic ratios. Level 2 is looking deeper into the red flags that have been thrown up by level 1. Level 2 is red flag analysis, and level 3, if we were to do it for forensic companies, is a kind of site visit where one of our Sherlock Holmes type analysts digs deeper and understands the fraud in great detail. It's seldom required because we're not going to make money by thinking about corrupt companies. It's very difficult to short in India. Unlike the Western markets, our country's market is so illiquid, you can't really short the corrupt companies and make money. As and when the markets become more liquid and you can short, then we will develop this side of Marcellus deeper, better, so that we can also profit from shorting these companies as they go, like Diwan Housing Finance did to becoming worthless. Does that make sense, Chari ma'am? That you got 3 layers: ratio analysis, deep dive onto red flags, and then site visit, where sometimes we even sit the promoter down and we talk him through the theft. And typically the promoter gets quite worked up, you can imagine, as you explain to the promoter how easy it is to see that he's stealing money.
Okay. I think as retail investors, they can look at 1 and 2, and if they are convinced that it is a fraudulent company, you just go for the next one. I don't think we'll try to go and understand the fraud, right? Identification, and then we stop there. Yeah.
Absolutely.
So the next question, what I'm looking at is, your entire Diamonds in the Dust book seems to be hovering around analyzing the financial statements. But we keep reading that markets are forward looking. They look at what's going to happen in future, and most valuation models seem to be looking at future. But how much time, I think, should you also not look into future? Yeah.
So we are not astrologers. A lot of people in India confuse investing with astrology. I have the greatest respect for astrologers, but investing is not astrology. So I'll request my colleague Rakshit to explain what investing is. And I think as Chari ma'am has already figured out, in our book, we have made a clear distinction between being Jyotishi, star sign analysis, planetary analysis, and investing. So Rakshit, how do you invest without doing forward-looking analysis?
Sure. Thanks for the question, ma'am. To begin with a simple analogy, so if you were to forecast greatness of a cricketer on the cricket field, right? You don't really have to forecast the weather report. You don't have to forecast the pitch report. You don't have to forecast what the cricketer will eat on the morning of the innings that he plays, so on and so forth. What you have to do is you have to understand what is the DNA of that cricketer really, right? Who is a disciplined cricketer? Why do you believe that particular cricketer is disciplined? And can you find out about a particular batsman or a bowler who, regardless of the weather report and regardless of the pitch report, delivers a great outcome? Right, that's a far safer and far more predictable way, I would say, of expecting the performance of a cricketer rather than forecasting the future, quote unquote, right? So that's an analogy. When it comes to stock investing in a similar way, what an investor needs to understand is, let's take the example of the pricing power of a business, right? There are various data points that you have to join in order to get convinced about the pricing power of that business. Some of those data points pertain to understanding the business here and now. Some of them pertain to understanding how the business has evolved in the past, because that tells you something about the DNA of those companies. And some of those data points pertain to how you see the risks evolve around that business in the future, right? So there has to be certainly expectations built into investments, but those expectations are different from quote unquote forecasting every quarterly revenue and profit, right? If you pick up a great quality company, all you need to then do is find reasons why you should be convinced about risk mitigating factors which can deliver a greater longevity and sustenance of greatness, right? If you are convinced about risk mitigants which help deliver sustenance of greatness, and on top, if you think that the external environment at least offers a platform, Indian economy will grow in that particular industry within which this company operates. That's it, really. You don't need to then forecast next year's revenue per se or next quarter's revenue per se.
Okay. So that your voice has gone off at the very end. I think the last sentence.
Yeah, no, I was saying there's a difference between building expectations basis risk mitigating factors which deliver longevity to your expectations, and understanding the pricing power of the business which delivers the rate of compounding of that business in the foreseeable future. You don't really need to forecast specifically every quarter's fundamentals. You don't have to forecast when the third wave will come or when the third wave will not come in COVID. You don't have to forecast what the budget will deliver on 1st of February next year, right? So that's the difference between forecasting and expecting.
Okay, so that's the way a lot of top institutions probably pick our students. We look at what they have consistently scored over many years, and then their attitude and their communication, and we start believing, yeah, you've done this for so many years, and you're going to be an outperformer in future, right? So that sounds very interesting. But how often do you revisit once you have made an assessment, building on your reply, once you have made an assessment that this company is going to be doing well, and then you have taken an investment call, how, if external factors change, competition changes, how often do you revisit? For example, if I may expand, DMart has been one of those companies which has been delivering good. He's a price leader, etc., etc. So now Amazon coming in, and then e-retail business is coming in. Then a person who's holding the stock from an early phase might start re-looking and rethinking, will this business really play out the competition well? Yes, no, etc., etc. So how often do you revisit, and how often do you re-evaluate, churn, etc.?
So we churn very little, Chari ma'am, in a given year. Perhaps we sell one stock, perhaps we buy one stock. There isn't that much point in churning. Remember, right at the beginning, we said today barely 15 companies control 90% of India's profits. So there isn't that much point in churning. The country has consolidated into the hands of a handful of companies. But there's another way, there's another framework Rakshit has created, which we use to reevaluate companies. And which leads to the low churn. So the low churn happens because there is very little reason to buy and sell in India. I request Rakshit to lay out the framework. In fact, the big parts of the framework are in diamonds in the dust. The framework which leads to reevaluation and at the same time results in low churn. Rakshit?
Sure. So I'll just project the framework as well. Yeah. So this is the framework. And we reevaluate companies using this framework literally on a daily basis. As frequently as possible, we reevaluate. So the first part of the framework, which is this vertical under moat score, is around reevaluating the pricing power of the company. What that means is, if let's say the external environment has evolved, right? So let's say we are sitting in maybe the first wave of COVID, right? Before the wave of COVID started, we could not forecast the wave of COVID. We had an understanding of why in a disruptive external environment, this company will deliver great pricing power. And through the wave of COVID, we have to keep collecting data points which tell us whether the company is genuinely delivering pricing power in the face of adversity or not. That's one piece, right? So we have to collect data points around pricing power in an evolving world, evolving in the external sense of an evolving external environment, as well as evolving from an internal sense perspective, as in companies themselves evolve. Senior management, individuals change hands, board of directors evolve, change. The customers of the companies evolve, the way the company serves the customer evolves, right? So too many evolutions are underway at any point of time, regardless of a black swan event happening or not. We want to keep getting data points which keep telling us whether the pricing power of the company is weakening or strengthening or remaining unchanged, right? So that's the first piece. The second piece is we need to keep looking at where incremental capital investments are happening, right? Which is under the lethargy score, you can see. So if, again, going back to the example of, say, the COVID wave, we want to see, is Dr. Lal Path Labs, which is a portfolio company, for instance, is it using this disruption as an opportunity to maybe build a new type of business acquisition process, which others cannot easily replicate? For instance, home collections, when everybody was homebound, nobody wanted to step out. Home collection infrastructure had a massive opportunity for scaling up in the calendar year 2020. We want to see if say a Dr. Lal Path Labs in the diagnostic tests is doing that. We want to see if Asian Paints is offering something around say labor services, because good quality and poor quality labor, especially around sanitization, especially around say supporting the contractual workforce to help you get a great labor experience out there in a safe manner, is an Asian Paints doing that, right? We want to see if Pidilite, I mean, it was quite interesting to see Pidilite acquired Araldite during the COVID crisis. This is an acquisition which might not have been as rewarding on the valuation of Araldite, on the timing, etc., had it not been for COVID, COVID type of a disruptive event out there, right? We want to see tech investments from our portfolio companies happen. And these are data points which will keep coming to you if we keep our ears close to the ground as frequently as weekly, monthly, sometimes even daily basis, right? And then the extreme right, we want to see evolution in the institution building as well, which is a little more gradual process. Things can't change overnight around building an institution, but we want to keep seeing those data points as well, right? So data point collection is an ongoing exercise. It is not infrequent. Just like you mentioned, you trust your students, right? Although you trust your students basis their historical performance and today's capabilities on an ongoing basis as they do, as they evolve as students, right? Whether it be through their marks or through their performance, that evolution has to be tracked frequently.
One more question related to the whole thing. You've been insisting on pricing power. But I think volume players are ones who follow low prices itself as a strategy and are into the market. So how would you like to look at volume players as opposed to price differentiators or niche players?
So Charika, you are most perceptive. That's exactly how great Indian companies destroy their rivals. Most great Indian companies, you'll see that their price hikes will not be more than 1 to 2% a year. In a country where CPI inflation is say 4-5%, the great franchises that we invest in, they consciously suffocate their competition by 3-4% a year.
Absolutely.
That 3-4% a year suffocation is basically margin destruction for the competition, and typically in 5 years they will bankrupt the competition, and 10 years out they'll be unquestioned, unchallenged leaders. So in this book we've explained this. We've explained it even more clearly in Unusual Billionaires as to how great promoters in India very consciously, deliberately take low price hikes well below CPI inflation. They know that suffocating a competition by 4-5% a year is something that has to be done. Lazy Indian companies hike prices as much as CPI inflation. That gives their competition room to breathe. And that's obviously not a good idea. Smart Indian companies, as Rakshit beautifully put it, smart Indian companies make sure that they use their pricing power to kill the competition and become unchallenged kings of the sector.
Yeah, I think Raju Iyer sir has raised his hand. Sir, you would like to ask a question? Yeah, Raju Iyer sir.
I think perhaps his line is frozen.
Yeah, it's frozen.
Yeah. Okay. So let me take the next question. There is a question from one of the CMA members. Do you think that the entire financial sector space today is getting more competitive, and more players like fintech coming in can lead to distribution of profit pools and dampen the sector growth?
No, reverse will happen. I guarantee you. Reverse will happen. We have 10,000 NBFCs in the country, of which 100 are prominent. Out of those 100, 80% will be wiped out in the next 10 years. These are corrupt NBFCs. They cook their books. They do naughty things with credit rating agencies. And the regulator is on to them. And banking sector, where you have, say, 40, 45 scheduled commercial banks. A decade hence, for all practical purposes, you'll only have 5. So if you see the UK or France or Germany, you'll notice they'll have 4-5 banks. They'll have 4-5 insurers. They'll have 5-6 large brokers. Our country today has 10,000 brokers, 10,000 NBFCs, 50 banks. We will consolidate the financial services sector, just like paints has consolidated and adhesives has consolidated and baby milk powder has consolidated and cooking oil has consolidated and hair oil has consolidated and trucks has consolidated. The financial services, which is 25% of GDP, 40% of the stock market, will consolidate into the hands of a handful of institutions, and immense wealth will be created. Immense wealth will be created for shareholders. Just to put it in context, public sector banks today have 60% market share in terms of loans outstanding, right? As I'm sure most of the distinguished attendees today know, no public sector bank in the last 20 years has generated a return on equity above their cost of equity. So how do public sector banks survive? All of us on this call, we work hard, pay income taxes to the government of India. The government takes that money and puts it in the public sector bank's balance sheet. And that's how the public sector bank competes with, for the sake of argument, with HDFC Bank, right? Now, this is no longer tenable, right? For a variety of reasons, which we can discuss some other way. This arrangement is no longer tenable. To be fair to the government has made it clear this arrangement is not tenable. So over the next 20 years, this 60% market share of the public sector banks will go to zero, much like what's happened with Air India. So how much wealth will be created by this? You can do a quick back of the envelope calculation. HDFC Bank market share is 6%. HDFC Bank's market cap is $100 billion. HDFC Bank's market cap is $100 billion. Market share is 6%. So 6% is equal to $100 billion. 60%, which is the market share of public sector banks, is equal to $1 trillion. So you can do basic mathematics and figure out that $1 trillion of wealth will be created as the public sector banks gradually shrink over the next 20 years. And people like us will obviously make money from that by investing in the 4 or 5 private sector banks who will fill the void. And $1 trillion of shareholder wealth will be created. This is how economic development works. This is how it's worked in America. This is how it's worked in Japan. This is how it's worked in Korea. This is how it will work in India. A handful of companies in every industry, whether it's banking, whether it is NBFCs, whether it is life insurance, whether it is adhesives, whether it is cooking oil, whether it is paint. 1 or 2 companies will take over the entire industry. Hundreds of small companies will fall by the wayside. That is how free markets and capitalism delivers growth, progress, and prosperity.
So I think that was nicely answered in great detail. I think we still have a few more minutes left. I would like to...
Mr. Raju has joined.
Yes, Raju Iyer sir has come in. Yeah.
Yeah.
Yes.
Thank you very much. Okay, I'm having a question, sir. In the annual report, if you take it, previously we were giving power saving and all that. Now in the present annual report, they don't have any information. So if the information on quantitative details, capacity utilization, and the power saving, and performance appraisal of the management, if these things are included, definitely investors will be benefited. Investors will have the real information on all these aspects, especially the performance appraisal of the management. Because in the management discussion analysis, but they don't discuss on the performance appraisal. They will only discussing strength, weakness, and those type of things only. How the company has performed, what is their real product. Those things has to be reported in the annual report so that to be useful.
So, sir, Mr. Mukherjee,
yes, sir.
After my vice president has spoken about this, I just have to add certain points here. You see,
yes,
whoever is investing in a company, either by way of providing debt or by investment, whatever it's doing, thing is that the system in India, there is a unique system of cost audit of 39 industries, where this audit report, where the performance appraisal is done, there are certain annexures. In fact, in the annual report, only there is no mention about the various aspects of the cost audits. You know, certain reports which are there, these are kept, these are shared between the board of directors, these are shared with the government, but it is not known to the shareholders.
Very interesting.
And ultimately, you see, in this system, Now it's a call of the day now, that when you are talking about transparency, when you are talking about forensic accounting, we are talking about forensic audit. Why it would be so much required when you will be finding that the capacity utilizations, the performance is, these are already known to the investors, prospective investors. In fact, prospective investors, they are not known about that. I am telling you, I have some experience that once a project has been, suppose it has been invested for 100 crores, suppose after 3 or 4 years, it has been stressed. The account has been stressed. When it has been stressed, it was found that what are the reasons that the appraisal has become defective? What's the appraisal? Because ultimately investors also appraising, and they are also having some appraisal system, as you have mentioned here, that for the companies, how you will show in your presentation. But in this appraisal system, there is no mention about the quantitative details, like what will be the capacity utilizations, how the company will be having their future, expansion. In fact, in COVID period, I'm telling you, the business continuity plan, which is not known to the investors, how the investors will know. So in fact, I am telling you, India is the only country in the world where the cost audit mechanism is there, where a cost auditor can give his presentations before the management, before the board of directors, even some of the excerpts of the report. If it is known to the investors, I think there would be a certain change in the mind of the investors. Maybe in the decision-making process, there should be a certain change. And that is in your book, I have found you have done a beautiful presentation, sir. But my request to you, kindly is just think on this code, that in this diamond, in this dust, there should be certain discussions on this matter, that how, because I'm telling you, some of the investors like banks, they have asked for the cost status report for 5 years. So what is their lacuna in our appraisal system? So I request you to kindly think on this and to discuss certain points, so that the unique system which is prevailing upon in the country, that should be utilized properly for the cause of the investors' protections. Thank you, sir.
Thank you. So I'll request my colleague Salil Desai, who's a chartered accountant, was an auditor, to comment on this aspect of, does the annual report do justice to the company? Does it give us what we need? And if not, what are the deficiencies in the annual report? Salil?
Yes, sir. No, sir, very, very, very relevant points that you've raised. In fact, if you ask any analyst of companies, then they will probably tell you that quantitative details is the thing that they most miss in annual report. I think for whatever reason, the ministry has taken a view that these are probably not relevant now. I think it has more to do with the fact that the nature of business is changing, where large part of the corporates are not necessarily now in traditional manufacturing businesses where these details are relevant or important. But I would tend to think that any business will have some unit economics. These are finally go back to what are unit economics of cost, capacity, and selling price. So like I said, every analyst would love for these details to come back, and I think it is for institutions like yourself to raise this at the appropriate levels and see what best can be done. And on the second part of management appraisal, yes, I think what some companies, the good companies, they're doing is they are fairly open about this. So what we have is they decide that there is a compulsion to, one is give a board appraisal report. That is, what are the factors on which the board's performance will be assessed. And those are available in the annual report, if not the annual report on the website. So you can always go and check what is being done, what are the factors or the parameters on which the boards are being assessed. But like I said, if institutions like yourself can take this up, it would be a very, very welcome move and increase transparency for everyone.
Thank you, Salil. Thank you. So, we are really grateful that we've got this time, such valuable time from distinguished people at NISM and ICAI. If you don't mind, we'll need to leave now. I have another engagement to head off to. But the questions that you folks are asking are very insightful. And in fact, this point that Chairman Saab and Raju Ayerji's made is actually very interesting point. I'm so glad you made this point. It's opened up a new vista for us.
Thank you, Mukherjee sir. Thank you. You have done a great job. Only thing I just want to conclude, as you have mentioned one thing that public sectors, 60% that issues you have told. My one submission to you, from public sector serves the country like India, where from the cobblers to the multi-millions accounts are open to the public sector banks.
Right.
And this financial inclusion, which has been one of the part of the public sector banks, perhaps in India it would not have been possible if the public sector bank did not play this magnanimity role in magnanimity. So I think in India is a country which is unique in nature. 29 states are there. 29 states are like India. So here, sir, public sector undertakings, beauty that is there, and it is my personal view that public sector will definitely serve the country in association. Whatever you have told, that the profitability and other things, definitely public sector undertakes will take care. But the capitalization, what you are talking about, sir, I think you have to have a relook, keeping the main frame of the country as a whole, which is the unique in nature in India only. Thank you, sir.
Right.
Thank you very much for patiently taking our questions. I hand over back to Madhumita.
Thank you, ma'am. Thank you very much for summing up the session so nicely. And we always love your question and answer sessions. And thanks to all the eminent speakers, guest of honor present today, Saurav sir, Rakshit sir, Salil sir, for enlightening us, and definitely for giving a patient hearing to all the questions. And thank you, Vice President sir. I mean, he has been attending all the webinars and webinars that is basically conducted by BFSIB. And we now have the vote of thanks by Sri Sunil Jayawant Kadam sir, registered NISM.
Yeah, thank you. I won't take much time now for vote of thanks. I think Saurav has to leave for another meeting. So thank you, Sauravji. Thank you, Salilji. Thank you, Rakshitji, for enlightening us on this occasion of reading the balance sheets and other related issues to that. There are many things more we need to learn. I think we probably have little more elaborate session with you, but some other day. I also thank all the senior dignitaries of Institute for supporting this all event. I also thanks to all my colleagues from NISM who have worked hard, and all the support staff from both the Institute and NISM have worked really hard to make this event successful. So thank you all of you.
At the last, I request Mr. Saurav Mukherjee, Mr. Salil Desai, Mr. Rakshit Ranjan to come to Kolkata to visit our institute. We have got 5 lakhs of students, more than 5 lakh students. We have got members of more than 85,000. Today, the members abroad India, they have also joined. We have seen the participation. And I am telling you, sir, we want to listen from you off ground, on the stage, so that there should be a beautiful panel discussions. In advance, I'm inviting you, sir, in our institute's 12th Sadasthi CMA Bhavan. Thank you, sir. Thank you
very much.
Thank you.
Yes, sir. Please do visit Kolkata whenever you come down. Yes. And please do make a visit. And thank you everyone. So can I just take a screenshot of the session?
Yes, please.
Yeah. Thank you very much. And we end the session with the national anthem.
We have to do it. Yes.
Jana Mana Adhinayaka Jaya He Bharat Bhagya Vidhata Punjab Sindh Gujarat Maratha Dravida Utkala Vanga Vindhya Himachala Yamuna Ganga Uchchala Jaladhi Taranga तव शुभ नामे जागे तव शुभ आशीष मागे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे